Hey, welcome back. So we're at the end of 2025, and this is when a lot of companies, a lot of analysts are looking back at what their predictions were a year ago, and they're showing you how they did in the year 2025. And Barron's is one of the most noteworthy predictors out there because they made some predictions for 2025 this time last year, and they beat the market. So the S&P 500 this year returned about 15%. Barron's 10 stock picks for 2025 went up 28%. So that's almost a double of the return of the S&P 500 this year. So if we look at the winners in Barron's 2025 stock picks performance, the key winners were Alibaba, Google, Citi, ASML, and Uber. And the key loser here was Moderna, the drug company. Even Barron's, the best of the best, some of the top analysts, they're not going to get 100% of their picks all the time. They're not complete fortune tellers. They're not always going to be right on the money all the time. And so Moderna was the big loser in their stock picks for 2025. But the fact of the matter is when you look at all 10 companies, they average a doubling roughly of the market. Market gained 15%. Barron's picks averaged 28%. So that begs the question, what's Barron thinking for 2026? Well, they pick their top 10 stocks for 2026. We see Amazon, Bristol Myers Squibb, Comcast, ExxonMobil, Fairfax Financial, Flutter Entertainment, Madison Square Gardens, Sports, SL Green Realty, Visa, and Walt Disney. So what we're going to do in this video is we're going to look at those companies using the Inner Flame Finance algorithm scoring method, and we're going to see, do we agree with Barron's? Do we disagree? How much of a margin of safety do we have? What is the intrinsic value of these companies? Um, I will note right off the bat that on this channel, we typically avoid looking at finance stocks and we avoid looking at real estate stocks. And so we are not going to look at SL Green Realty at all. We are not going to look at Fairfax Financial Holdings at all. The one exception is we will look at Visa. Visa is such a solid company. We have a decent handle on their numbers, and so we will include Visa for intrinsic value calculations, but our scoring techniques are not useful for real estate stocks or financial stocks. So we will be excluding those in our analysis. So just a reminder, if you get anything out of these videos, they take quite some time to put together. And so I would appreciate it if you like this video. I would appreciate a subscription to this channel. Every day we try to put out quality content to help you with your investing decisions and to help you build wealth for the future. Also, another reminder that nothing that we say on this channel is financial advice. We are not telling you to buy, hold, or sell anything. You always need to do your own due diligence, do your own research when it comes to investing, and only buy, sell, and hold stocks that make sense for your financial situation, your financial future. So you can see here that we have 6 of the 10 companies that Barron's chose for 2026. We have Bristol Myers, Amazon, Comcast, Disney, ExxonMobil, and Flutter Entertainment. We are excluding Madison Square Garden Sports, mainly because they had no EPS, rather negative EPS. They have no PE, and the numbers are just too bad for our evaluation techniques. We're also excluding Visa, and we're excluding the other financial company in that. Again, we don't do financial companies. Our methodology for scoring basically doesn't handle those types of companies. So at the top of the leaderboard for growth is Bristol Myers, and we have Amazon coming in at 3.9, Comcast at 2.8, Disney also at 2.8. Now, on this channel, what we do is we rank companies between -10 and +10. -10 is complete garbage, +10 is the best company in the world. And so we see that anything positive is pretty decent, but we want quality companies. And so typically on this channel, we only choose stocks, we only choose companies for our portfolios that score 5 and above. We want the top of the best. We want the top 25% to even look at. However, for the purposes of this video, we will be looking at many of these companies, even when they have scores below 10. So let's just take a peek at the numbers. So Amazon, they have fantastic return on invested capital at 12.8%. Their revenue growth for the next 5 years is expected to be 11.5% annually. They're coming in with a 5-year forward PE at 12.8. If you can get Amazon for a PE of 12.8, that is fantastic. We all know Amazon. We all use basically on a daily basis Amazon, either their web services or their streaming services, Amazon Prime, and we just buy a bunch of stuff off of Amazon. So to get a quality company at a 5-year forward PE under 13 like this is phenomenal. Bristol Myers Squibb, they are projecting annualized EPS growth at over 70%, which is why we see a 5-year forward PE coming in at 1.2. Their PEG ratio is basically non-existent at 0.1. That is phenomenal. Remember, we want PEG ratios to be under 2. Under 1 is a steal deal. 0.1, that's a screaming buy as far as PEG ratios are concerned. Forward PE of 9, fantastic return on equity, fantastic return on invested capital. It looks like Bristol Myers is in fact the real deal when it comes to 2026. Comcast, we see forward PEs at 4.4 over the next 5 years. Forward PE for next year at 7.3. The second best return on equity of all these companies coming in at 24.5. Their profit margins are a solid 18.3. We see Disney. All right, Disney's starting to come around again. They cut their dividend for a while. Now they're reintroducing their dividend. They have very little debt to equity. They have really decent profit margins at 13.2%. So Disney might be a somewhat quality play. They're coming in at a 2.8 on the growth score, but that remains to be seen what they can actually do in the coming years. Now, Flutter Entertainment, this is the big grower. This is the one coming in at EPS growth expected at 72%, revenue growth at 13%. They don't have a 5-year forward PE, mainly because they don't have any profit right now. And so we cannot take their current PE and extrapolate that into the past 5 years. However, they do have a forward PE of 24.6 and a PEG ratio of 0.8. So we have a company here that has a lot of growth expected for the future. In our analysis, we will not use anything close to 72%. We want to be conservative and on the safe side. But when we look at the intrinsic value of Flutter, we will certainly possibly take something into consideration that does lend itself to high growth, but probably not 72% for the next 5 years. And finally, ExxonMobil coming in at a growth score of 1.1. The energy sector, in particular, oil companies don't tend to grow a lot. They're very cyclical in nature. It is coming in with a 5-year forward PE of 12.7. Very little debt to equity. Their PEG ratio is quite high at 3.2. Again, this is not a growth company by any stretch of the imagination. When it comes to safety plays, all right, this is where ExxonMobil shines because they do offer that dividend. They offer a healthy dividend. Bristol Myers is coming in at a 5.7, Comcast at 5, Disney at 4.3. Amazon, the reason why Amazon is scoring so low for safety is primarily because they don't pay a dividend. If they paid a dividend, if they were to flip all their revenue growth into earnings growth into dividends, if that translated into income streams into our portfolios, if we were to get a taste of that profit from Amazon, then the safety score would certainly be a lot higher. When it comes to Amazon, when we look at the safety metrics, again, we see no dividend yield, but we do see very little debt to equity at 0.4, current PE at 32.9, return on assets 9.6, return on invested capital 12.8. Bristol Myers Squibb, we see their dividend yield coming in at a very healthy 4.6%, which is why we have such a high safety score at 5.7. Fantastic return on invested capital and return on assets. And again, that 5-year forward PE coming in at 1.2. That's phenomenal. Comcast is coming in with a PE at 4.9, super low currently. Dividend yield at 4.5%. 5-year forward PE again at 4.4. Everything's looking good for Comcast in terms of safety because not only are they coming in with a healthy dividend, but they are growing their dividend 6.5% year over year. Now, this year's dividend growth, I mistakenly put these in as percentages. Let me undo that and just make them numbers, and we'll knock off a couple of those. Bristol Myers Squibb is not only a dividend payer, they have grown their dividends for 18 consecutive years. That's very promising. Payout ratio is getting a little high at 83, 84%. So can they maintain that dividend growth? That remains to be seen. Disney, they're only growing their dividends for 2 years. Again, they cut their dividends during COVID and during the slump that they found themselves in. They have recently grown their dividends by 50%, so that's nice. They're coming in at a 1.3% dividend yield, PE ratio of 16.6, very little debt to equity. Flutter, now this is something that they have no dividend at all, therefore no growth. We cannot project their 5-year forward PEs. They currently have no positive PE, so we do not include that. And they have somewhat high debt to equity, but that's typical for very, very high growth plays And finally, ExxonMobil, 44 consecutive years of dividend growth, very little debt to equity. Their current dividend yield is 3.4%. And again, their 5-year forward PE coming in just under 13. So those are the 6 companies that we will be looking at. We are going to run intrinsic value models, and we're going to see what analysts think on Wall Street and compare our numbers to what the analysts think. So on this channel, we're going to run 2 different intrinsic value calculations. We're going to do the PE multiples, and we're going to do the dividend discount model for most of these companies, right? The companies like Amazon that don't offer dividend, we obviously cannot do the dividend discount model, but 4 of these companies have pretty healthy dividends, and so we will be doing dividend discount models. So if you want to see where I get these numbers from, if you want to see how to build out a Google spreadsheet like this for yourselves, there are links in the description below to see how to do the PE ratios model, which takes their earnings per share, projects it out 10 years, scales it back with a dividend discount, or with a discount rate rather, to see what the current present value of that earnings per share is. And we also look at projected future price to earnings ratios. And again, if you want to build that out yourselves, if you want to see step by step how to build these spreadsheets out, to use your own numbers, to use your own analysts' expectations, if you know some analysts that you value, or even just your own analysis, then you can throw all those numbers into your spreadsheet. And again, we also do a dividend discount model for the ones that offer pretty healthy dividends, typically over 1%. So we do that for all 4 of the companies, dividend discount, and we also do it for all 6 companies, and we will find what their intrinsic value is as a whole. So here on the final sheet, we see what their score was. Flutter coming in at an average score, both growth and safety averaged out to be about -4. Amazon coming in at 3. Again, we typically only choose companies that have scores above 5, but Amazon is special, and we want to see how Barron's picks compare to what we think these companies are going to do. Amazon has a lot of future, has a lot of room for growth still, and so those numbers don't really come out in our analysis. We will give it a pass. We will use that score of 3 as the average score when we determine how to allocate our capital. But we do want to point that out, that typically on this channel, we want to look for companies that come in over 5. ExxonMobil 3.05, Disney coming in with an average score of 3.55, Comcast at 3.9, and the only company coming in with a score, with an intrinsic value score well over 5, is Bristol Myers Squibb, coming in at 6.2. So let's look at these one by one. So Flutter, we couldn't find any intrinsic value, mainly because their earnings were still negative, earnings per share is still negative, no PE ratio to speak of, so we don't have an intrinsic value for Flutter. Now, Barron's could be right. That could be the next big thing to 10x your money in the next couple of years. But on our channel, for how we invest and how we score values, or how we value companies, we're going to skip Flutter. Amazon, current price is 233. The intrinsic value is 375 according to our calculations. That gives us a very healthy 38% margin of safety. If we want to look at what analysts think, well, they're coming in with an average price for Amazon of 284. So we are certainly very, very bullish on Amazon. Again, we are coming in with an intrinsic value of 375. That is higher than even the highest expectations on Wall Street. Regardless, Wall Street thinks that this is a strong buy. We are seeing an average increase in price over the next year of between 22 and 29%. So not only do we agree with Wall Street, we are coming in very, very bullish on Amazon, even with this very low score. I want to remind you that we are using a weighted average that takes the score of 3 into consideration. Amazon, in reality, probably has a growth score closer to 5. And so, we're very, very bullish on Amazon here at Inner Flame, and that's even with what we feel to be kind of a low average score. If you look at ExxonMobil, not a lot of room for growth, coming in with a margin of safety of 5.5. Price is currently $119. We think it's worth $126. If we look at ExxonMobil, this is rated a buy among Wall Streeters. High value of 158. Average price over the next 12 months is coming in at about 131. Again, we are thinking it's 126, so we're a little lower than the average consensus on Wall Street. Not a lot of room for growth in energy stocks, and we typically don't consider such things anyway. Disney currently trading at 114. We think intrinsically it's 148. These intrinsic values for both ExxonMobil and Disney are using the dividend discount model, as well as the PE multiples model. So remember, these are just averages of those two. So we have a pretty healthy margin of safety of 23%. If we look at what we think Wall Street is looking at, they're looking at $135 per share, coming in at a strong buy. So Wall Street is very bullish on Disney for the next year. They think on average it's coming in at 135. We think here at the channel that it is 148. So we are more bullish than the average consensus on Wall Street. The top analyst is thinking 152, and we are very, very close to that top analyst at 148. Comcast is currently trading for $30 per share. We think it's worth $59 per share. That gives us a very healthy 49.7% margin of safety. So we think it's 59. We are coming in higher than the most bullish of analysts. They think Comcast is worth more around 38 on average, coming in just over the buy mark, just over hold. It's very, very low into the buy territory. Finally, Bristol Myers, we have a score of 6.2. The price is currently $55. Intrinsically, we think it's 111. That gives us a very healthy 50.8 margin of safety. Bristol Myers Squibb, we think it's 111. We are way, way, way high compared to what Wall Street thinks. Wall Street thinks that it is only $56 per share on average. Not a lot of room for growth. They're currently trading at $54.64. And so they only see a couple bucks of growth for the next year. The highest analyst is coming in at 68. Again, we're coming in at 111 based on the growth numbers that we used for this channel. So, take that how you will. Barron's is very, very bullish on this. This made their top 10 list, and so we will see what happens in the next year. When it comes to all these companies, they score the highest and they have the highest margin of safety. So this would be certainly something that we consider for our Interflame Finance portfolios. And finally, just to show you Visa, intrinsically, the price to earnings multiple model came in at 338. The dividend discount model came in at 577. We averaged those together. Intrinsically, Visa is worth $458. They're currently trading for $355. That gives us a very healthy margin of safety, over 20% at 22.5. So we think it's worth $458. We are slightly higher than the highest analyst on Wall Street. Their average is about $400 per share. Analysts on Wall Street think that in the next year, Visa is coming in between 12 and 13% growth. So if you got anything out of this video, please like and subscribe. Tell your friends, tell your family, tell your mother-in-law. We'd love to have them join us. We'd like to, we love doing this analysis. We like showing you how we think about stocks, how we value stocks. Nothing that we say here is financial advice, so we're not telling you to buy, hold, or sell anything. This video is for entertainment and information purposes only. But if you get something out of this, please like and subscribe. If you agree with any of these picks, if you disagree, let us know in the comments below. What are you picking for 2026? We'd love to know. If you have any requests for sectors or stocks or companies or themes in the stock market, let us know about those and we will run those numbers for you. Appreciate you watching. Thank you very much and have a great rest of your day.